All right, this is Chris from MarketSwingTrader.com. Today we're just going to go over options 101, just the basics of options to get you familiar with them. This is only an educational video and it's not an endorsement to purchase any stock or option. It's only used for educational purposes. Please make sure you consult a licensed financial advisor before investing in any real money. And always make sure to pay per trade. Now, options. Some people think this is very confusing. It can be in the beginning. The one thing you need to understand, it's not as simple as just buying low and selling high. You do need to do some of your technical analysis. I'm mainly trade technical analysis style. I'm not a fundamental trader. So when I'm doing options, I do look at technicals. I do have a trading plan that I like to follow. I have certain indicators that I use. So this educational video is just going to go over the basics of options and get you familiar with the Thinkorswim platform. I like using Thinkorswim for options. They have tremendous amount of features for options. I don't even know if there's another platform out there like this. I've just used it for years and I like Thinkorswim. So with that, what are options? It's a contract that is sold to one trader, the option writer, to another trader, the option holder. The contract gives the buyer the right but not the obligation to buy or sell the security on the agreed price. Now the agreed price is the strike price. And all contracts, which are options, will expire on a certain date. That is one thing you really need to understand is prices will fluctuate on the stock, and also that option or options that you are in will expire at a certain date. Now that date is on the third Friday of every month. So if we go down here, we look at November. Well, the 18th. That's the third Friday of the month. That is when that's when November options will expire, is on the 18th. If you go to December, they will expire on the 16th. January 2012, they expire on the 20th. So the third Friday of every month. So when you go to Thinkorswim, now I'm looking at the SPY, and you do have weekly options. And that'll be another educational video. But I do like weekly options. Now right here we go to November. Now with Thinkorswim, right there in the parentheses, you will see 7. That means you have 7 days to expiration. If you go down here to December, that means you have 35 days to expiration. If you want to go to January 2012, you have 70 days until expiration. Now I'm going to look at December 35. We have 35 days to expiration. Now on the Thinkorswim platform, your calls are on the left and your puts are on the right. Now right in the middle, right in here, is your strike price. As you can see right here, the strike, that's your strike price. If you need to see more options, you can go to your strikes and you can choose like all of them. Or you can actually type in 10, hit enter, and you can see more strike prices. I usually just keep it at 9. So on the left side you have calls. Now a call gives the right to buy. The stock needs to go up in order to profit. So if you think, let's say the SPY, let's say you think it's going to go up, and right now it's trading at 126.78. So you think it's going to go up. You can go over here and you can just click at 127 strike, and that is just one contract. That is buying a call. So that stock needs to go up in value for you to profit. Now if you think the SPY is going to go down, then you can go over here and you can buy a put. Now, buying a put means it needs to go down in value. It gives the right to sell. The stock needs to go down in order to profit. Now, there's different things that you can do, and you can do a combinations of different strikes and different months, and we will get into that later. What also, when you are purchasing calls and puts, the one main thing that I look at is the bid and the ask, the spread between the options. So right here you have a bid and you have an ask, and it's at 377 for the bid, 379 for the ask. So there's a 2-cent spread, which is pretty nice. I really like that. Now let's go over to a different stock. Let's say we want to look at BlackRock, and BlackRock's a good company. I do like it. I wish I could really trade BlackRock with options, but I just don't. And the reason I don't is because the bid and the ask is too wide. It's at 710 and 760. That's 50 cents spread. That means if you go market value right away, you're already down 50 bucks. I just don't like that. But when you look at Apple, let's look at Apple. Apple, as you can see, the spread for the 390 is 13.10 and 13.20. That's a 10-cent spread. Now, if you can get in between the bid and the ask, that's like 5 cents. So that is the main thing that I like looking at, is the bid and the ask. And also, I like looking at the open interest. Now, that just means that we have liquidity. The higher the open interest, which is good, we have higher liquidity. So we can get in and out of them pretty easily. Now, sometimes you'll see if we, like I just put on a trade with Whole Foods. As you can see, the bid and the ask is decent, but I got filled right in between the bid and the ask, between the mid and the natural, and we'll go that in the later future video. Now, the open interest is at 287. I don't like it really, but it's not too bad, because as time goes on, and we got 7 days to expiration in November, you can see it's like a couple thousand for open interest. So I should be able to get rid of them pretty easily. Now, also, I could just go out market value and just go ahead and get out of them. But I like trying to get filled in between the bid and the ask. Okay, and with this, I did get filled pretty easily between the bid and the ask. So there are people out there buying up those options. So that's the main thing. You want to look at the bid and ask, the spread. You want to look at the open interest. Let's go back to the SPY here. We go to December. Now, there are, well, before I go into different types of options, when I say contract, let's say we buy a call on the SPY. We think it's going to go up at 127. So we purchase a call. Now, one contract right here, plus one contract is equivalent to 100 shares. So let's say before December expiration, let's say it's up. It's trading at 128. That means you can go ahead and exercise your right and get 100 shares because you had one contract. Or you could just go ahead, instead of doing that, go ahead and sell your call out onto the market. You don't need to purchase those shares. because your call has gained value because the stock went up, you can actually sell that call to someone else. You can just put it back into the market and you can profit. So let's go over to the risk profile. And this is the one thing I really like about Thinkorswim. This risk profile is something that you are going to use all the time. We purchased one call at the 127 strike. Now the stock needs to go up in value. Now this red line is your expiration line. Your white line is what it is currently doing right now. Okay, down here you'll see 11:11, that is today. 12:17, if you look at 12:17, if you go right here, 12:17, that's when the option will expire. See, it actually expires the next day, but I mean, we can't trade on Saturday, so that's why that is. Now, as the stock goes up, the value of that option will go up. So if we go down here to the wrench, let's say we think it's going to reach to 128. Okay, so it goes to 128. Let's say it takes till the end of the month to do that. So we go down here to the 11:30. As you can see, we're losing money. The reason for that is because of theta, and you need to look at the video about the four Greeks to understand that. When you are purchasing a call, you not only need to be right in your direction, but you also need to be correct in your timing. Because buying a call or buying a put, it's negative theta. Theta is working against you because of time decay. Because options will decrease. They'll lose their value as time passes on. Now, if the SPY at the end of the month is up to 130, then you would make money. As you can see right here, the P&L, it would be $121. And that white line is the expiration. So this line right here is the break-even point at expiration. So if we go right here and then go to the 16th, that right there at 130.80 is just basically your break-even. Then you go to 12.17 and it's over. So I will go in more detail about the risk profile, but I just wanted to go over the basics of calls and puts, and you need to understand that just buying a call, you need to be right in your direction and your timing, because you are paying out theta and that call will lose value, so it needs to move pretty quickly within 35 days. Now there are two types of options. There are American style options, which is an option that can be exercised before expiration date. That means, let's say you buy a call at 127 and the SPY goes up to 130. Before expiration, you can go ahead and exercise your right and go ahead and get, if you have one contract, go ahead and get 100 shares. You'll just have to exercise your right. Now, European style option, an option that can only be exercised at expiration date.